Netflix stock is diving after the company announced a major acquisition of Warner Bros. Assets. Investors are spooked, the market's reacting fast, and the entire streaming landscape could shift. Today we're breaking down why Netflix stock is dropping, what this deal really signals, and whether this creates risks or opportunities. Let's get to it. Welcome to another video. My name is Robin, and as per usual, I'm joined by Kirill. And today we're gonna look into Netflix and why it's dropping after this announcement. But before we dive into it, first let me make an announcement to you guys. If you like the content today, then feel free to hit the subscribe button. It will help us a bunch, and we will return every week with another video, with another stock valuation, with another company insight. If you want us to do any stock at all, then feel free to drop a comment. We'll read all of them. And of course, we will also reply. Today, we'll also follow our 3-step valuation method. We'll go over what's in the news. We'll go into the company fundamentals and finally the value that you're going to get out of this video. We're going to leave you with a valuation of Netflix. But guys, do your own due diligence. This is not financial advice. We're just learning together. And of course, if you want any support with your due diligence, then 930 is the place to go. All right, crew. So, what's in the news?
Yes, it's been a very bumpy ride for Netflix for the past, a few months actually, to be honest, because ever since the beginning of the year, the stock only appreciated 2.6%. And to be specific, we are down from the highs of $134 per share in June, July of the year. We're at the moment at $95.8 per share. And the reasons, there are many reasons for that, but the biggest one is, at this very moment at least, is related to the deal of purchasing Warner Brothers. That's the, let's say, the takeover that Netflix is planning. And what's even more important and more interesting nowadays, what's actually happening is that Paramount also is jumping into it, and they're saying, like, you know what, we're actually offering $108 billion in cash right away. We're also on Warner Brothers. We're really interested, and we want to jump on it right now. So pretty much now there are two companies who are fighting for poor Warner Brothers. So it's a really interesting situation that's happening at the moment. I think, Robin, correct me if I'm wrong, that's actually the first time when I see two big companies actually competing for another publicly traded company, let's say pretty much live in the news, which is pretty interesting. But then it also just begs the question, how does it affect Netflix? Because that's what we're talking about right now. Is it also an interesting opportunity to jump on at this moment since the stock is going down, or maybe that potential deal is actually going to harm them quite a lot? So this is something that we're going to look into today.
Yeah, but before, of course, we jump in, there's also another variable in this case. So as you might know, as a viewer of this video, most companies who buy over other companies in the same industry, they have to go through a process for, basically the government checking whether or not consumers are better off with the deal. And now US officials, they actually voiced fears that Netflix will be too big for Netflix, that Netflix will be too big for Hollywood. So it's not set in stone yet, and the fears that the deal might not go through, either by the new $1 billion deal coined by Paramount, or whether or not the deal will go through the US officials, it's still iffy. But we will check in. We'll go into this in a bit. Of course, it's also interesting to see what happens to Netflix whenever they get like the Warner Brothers and HBO, and what happens when, for example, the subscriber base transfers with them. So, Kirill, shall we start at the company fundamentals?
Yes, of course. Yeah.
Yeah, so we always start with the 930 score. So here you already immediately have you can see the financial health of the company in a bird's eye view. So Kirill, it is a C. So what does that mean?
Yeah, so we can see that again for the past. I think the 930 score indicates the past Oh yeah, past 20 years. So this is also pretty much since the inception. So that what we're trying to do with a 930 score, we try to assess the longevity of the company in terms of its financial performance overall. So we're not trying to jump on, let's say, what has been happening only on the past year or two or whatever. No, we're actually trying to have a more comprehensive approach. So if you're buying a business, you're buying a share of a company, so you should have a full understanding how it's been performing over a long period of time. So what we can see with Netflix, of course, is that we can see a good performance in terms of revenue growth, which is really nice. Same story when it gets to the stock price appreciation. So it means that the price growth of the stock itself is there, and it's quite consistent over years. Then we also have more or less the same good thing when it gets to the net income growth. However, the company is lagging in terms of the free cash flow growth and the marginality. And the same applies for the PE ratio, because the company is growing, you have to pay more for it, so hence the PE ratio score is poor. So you have to pay extra buck, let's say the premium, if you would like to get the Netflix share.
Yeah, exactly, and we'll go over what it is now. So Kirill, let's dive deeper. Let's go into the financial health of Netflix. So again, over the past 20 years, Netflix has been performing, has been growing at a pace of 23% per year. Over 20 years is quite impressive. Average net income growth 68% is insane. On average, of course, it has been slowing down since new competitors came into the market, but still, the free cash flow growth has not been growing as much as you would expect, but it's also given, of course, that we are looking at the whole 20 years, and they also need to invest a lot, as Kirill mentioned earlier. Long-term debt's not really covered by their free cash flow, which is a problem, and we do value a lot of stocks where this is not such an issue. So we will also check if that's somewhere recent or if it's now in a better position. The average share buyback is negative, meaning that they are diluting you. So the share of the pool of shares is not getting smaller, but it's getting bigger. And as an investor, this is not something that you would like to see. You would like to see them actively buying back shares. And then they also don't pay a dividend. So they do not really provide shareholder value in this sense. So when you're buying Netflix now, you're buying it for the premise that the price is going up. Of course, you do that with most companies, but they do not do it. They do not artificially inflate the prices that way. So yeah, Kirill, if you don't have anything to add, let's go to the data.
Fully on the same page with you. Yes, let's roll further. Yeah, we can see, as Robin mentioned, still more or less consistent growth even on the past several years on the revenue and the gross profit, which is really nice to see. Of course, proportionally, the R&D expenses are also rising. Of course, you need to maintain your competitive advantage. You have to spend more time into the platform, create new product bundles, for example, offering the games, offering the live sports, and so on and so forth. So you have to spend the money as well to be on top of the competition, which is completely sensible. Totally makes sense. And then you can also see that the net earnings are also going up, which is totally good.
Yeah. Exactly, and here we can also just look more into the share outstanding. So we can see that they really diluted the most in 2007, where they had quite they were on top of their issuing of shares. That went down 2010, and then it steadily went up again. And I think now we are past the peak again. And in 2024, it has been declining compared to 2023. However, make sure to understand that also with this deal, they will also probably issue more shares, because they are so that as the deal stands, it says that they are buying it for 72 billion, the TV, film, studio, and streaming division, with roughly $27 per share, and that is divided in $23 per share in cash, and also $4.5 of Netflix common stock. So they will raise capital through stock, which means that they will dilute probably in 2025, 2026, depending on when the deal is finalized.
Yep, exactly. And it's also really good to know, especially in the light of the Paramount offer, which is way more than what Netflix has to offer. I think, what you, Robin, mentioned. So they plan to offer 82.7 billion, at least according to Yahoo Finance, and Paramount offers 108 billion. So that's a bump. And also on top of that, Paramount offers it in cash. So what Netflix has to face at the moment, either they have to actually pay more, so they have to outbid Paramount, or they say, okay, sure, we call it quits, it's too expensive for us, we go out, but then they are losing the asset that they're hunting for. So either ways, I think for a shareholder, this is something that you need to consider. Let's say what would be the outcome in both of the cases.
Yeah, exactly. I fully agree.
Yeah.
All right. So now it's time to look at the ratios, because of course data in of itself doesn't really say a lot, right? Oh, we still have to look at some other data points.
Yes.
But I don't think there's anything.
Yeah, you're too quick. I think these last three graphs are really important. What's happening on the better side is that Netflix is paying down their long-term debt. So from the highs of 2020, which was $17.7 billion, they paid it already down to 15.7, 15.8, which is good. It's consistent. It's going down. It's good to see. And on the other hand, you can see that the free cash flow is also growing to... So from 2022, it's been only 1.6 billion, and then it skyrocketed to almost 7, and at the moment it's 7.5 almost, which is really good to see. And especially it's very important if you would like to stimulate these kind of offers for the acquisition, to pay down your debt and so on and so forth. So this is actually good to see. So we're probably going to go into the ratios a little bit in a moment, as Robin mentioned, but at least if they're improving their bottom line, if they can normalize their operational activities, make them more profitable, that's of course way better for the shareholder as well, because then this is a way more financially stable company, and then they can do all of these shenanigans like acquiring Warner Brothers, Disney, anywhere, who they want, expand into other product category, service offerings, and so on.
Yeah, exactly. If we look at the ratios, we can see the net earnings ratios creeping up to the 20% mark, which is something we like to see. It just indicates healthy net earnings. The research and development ratio is way below 40%. It's also decreasing, and this is also nice to see. They have their platform, and they're not building some really sophisticated AI systems, or they don't have really supercomputers that they're working on. It's basically their the media player that they have. I'm no tech guy, but it shouldn't be that difficult to put up, to be honest. I'm not sure if our lovely developer can pull it up on his own, but needless to say, it's less of an investment in the platform for like a media player than, for example, a whole AI system. So that's also why they can keep the cost down, and also they are buying productions after they are finished. They're either licensing, for example, the series or the movies, so they don't really have to produce movies themselves, which is also keeping down the R&D. And then they're also, of course, they have their own brand name, Netflix, which is really known in the market, in the industry, and around the world. So they are also, of course, piggybacking on that. So they don't need to invest that much. They have the moat, which is good to see.
Fully agree. And you can also see the same story happening with the depreciation to gross profit margin. So of course, the lower it is, the better. So it pretty much means that they are spending less on the creation of the content that depreciates over time, versus let's say the amount of money that they have to make. So this is really nice, of course, all the time. Only trouble is that I can see at the moment is, of course, the situation with the revenue and the free cash flow growth. You can see it's deteriorating, but also for the obvious reasons. Of course, you are the biggest on the market. There is some growth to still have globally, but I think the US market will already dominate. There is some competition also with Disney, with HBO Plus, that they're trying to silently eliminate, let's say, and some other streaming services. So it also probably is gonna beg for a question of like, how can they increase the revenue further? They already did the crackdown on the passwords, that you cannot have them from different IP addresses and stuff like that. To me, as a user, not happy at all. For the financials of a company, as an investor, I'm probably happy because they're improving their financial position. It's also a question of how long the users would be happy to keep it this way, because if you're constantly increasing the subscription price, you put ads in there and these kind of things, while the product more or less stays the same in terms of the quality, in terms of the content in there, then there's other competitors you can switch to, so it's the switching cost in here is rather low when it gets to Netflix. So that's why they really have to fight the churn or remove the competition.
Exactly. Yeah, agree. And we might even see a increase in revenue growth once HBO is incorporated within Netflix. Whenever the HBO Max or Plus or whatever subscribers come over, then you might see increase in revenue growth. But yeah, would you say they're already entering the proposition of being a cash cow at this point? They have so many subscribers, and
yeah, it's a good question, because I think they still have the option of growing into other segments of entertainment, right? So we see they already have the mobile games bundles, where you can just, through Netflix app, you can just download some of the paid games but for free, which is quite nice. Then they are also entering the live sports category. Maybe they are gonna be just a one-stop shop for like all family entertainment. They are gonna, maybe, that's at least my take on it. That would be great if you have, let's say, the ebooks subscription in there, if you would have maybe your music subscription in there. That would be great, because then you don't have to suffer with having gazillion subscription. Everything would be under Netflix. I think me as a customer, I would be happy with that. And for that, I would be probably more interested in paying a little bit more, paying for the convenience. But it's a really long shot as well. And I hope also my vision for Netflix also aligns with the vision of the board and the CEO. But I think we'll see in the future.
All right, let's just continue and see if there's anything else. So the gross margins, healthy, above 40%. Operating profit margins are also climbing up to healthy numbers. So good to see. I don't have anything to add. I think Kirill, if you're happy.
I'm always happy. As long as you're happy, I'm happy. Yeah.
All right, then we jump into the valuation of Netflix. Yeah. So if this is the first time you're watching our videos, we will guide you through our valuation tool and our method. So as you can see, we have the assumptions based on 3, 5, or max years. This only changes the numbers that you can look at, basically. So Kirill, we start with the free cash flow starting point of last year, and especially in this case, I would of course be advised to do that as well, given that they have been positive in the recent years and not any other year. For the projection period, I mean, they're one of the bigger players in the media market, in the industry at least. I'm not sure if there's any. I mean, there's competition, of course, of Disney, which we cannot ignore, and Paramount, which we just discussed, and HBO is still there. But I think that there's always a need for entertainment. And I think the way they are developing of being like this all incorporated platform will also help them being relevant for longer. But again, we cannot look into the future and understand fully what other businesses will pop off now with AI. So I would say 5 to 7 years, Kirill.
Yeah, I fully agree. And I think also what's really important to highlight is the fact that there's only probably one competitor in this market where Netflix is operating that has more or less healthy and stable financial position, which is Apple, because they have their Apple TV. The rest, again, you have HBO, you have I think it's also Paramount Plus or whatever. You have Disney. All of them have another source of income that is related to creation of content, which is also quite asset heavy. In Apple, they have their ecosystem with hardware, with software, and then they just pretty much subsidize Apple TV creation, so they can pretty much develop that tool and develop their platform on a longer term without pretty much having much trouble with the cash position. Netflix is the best out of them. They only focus on this part, and then you can also see that they are improving on their cash flow as well. So that actually gives again another sign of the fact that they have pretty good moat, and especially since they've been on the market for quite many years, and they developed from sending DVDs over post to having their app installed on every probably almost every TV in the world, which is super cool.
Yeah, exactly. Great. For the discount rate, we normally put in 10%, but you can play around with this number as you like. Then for the estimated growth rate, so we see the average for 3 years for the revenue has been 9% and cash flow has been 3.7. 5 years, it's a different number, but we have to account for the negative cash flow. I think 8% would push it. So I think if we are pessimistic or more or less conservative, I would hover more towards 6%. But we can always, of course, check what our friends at Yahoo Finance think about the growth. While you also, Kirill, can look into the projected PE ratio with our viewers.
Yeah, exactly. So it's something that we can adjust when we are doing our exercise. If we also think that the growth rate is gonna gradually go a little bit lower, then it means the PE that you should be paying for the stock is also usually should go lower as well. So if we assume, and then while Robin is checking, that for example we want to put the growth rate of about 6%, then I would also say that I would not really be willing to pay really more than 40p at max at the current level, especially considering the current market situation.
Yeah,
but yeah,
and also the industry PE is around 30 of entertainment. I found that the analysts, they assume that for this year Netflix is going to grow by 27%, and next year is going to be another 27%.
Good for them. I'm really happy for them. Sounds a lot though. But this also for the revenue, right? You were talking about.
Yeah.
Okay. What we can always do, we can just let's say put a more or less pessimistic one for a longer period of time, and then whatever the people say, we can put 20% for the upcoming 2 years. And now we can see what the range is as well. So it's not a problem at all.
Yeah. Just we have to keep this constant for 7 years. What would be realistic? If we are assuming at 7% it's going to double in the 7 years time, that will already be insane at the stage where Netflix is at. But yeah,
indeed. Okay, so shall we start with what was it, 6-7% that you wanted to put
6.
in? 6%. Okay. Yeah. And the PE?
And for you just discussed the PE. I was zoned out.
Yeah, let's do. Yeah, no worries. Let's do 35. Let's say just a little bit higher than the industry average, just for the sake of Netflix prospects.
Yeah. For the required rate of return, because you're stock picking, you have a bit more of a higher risk compared to investing in the S&P. The S&P in general has been delivering between 7 and 10% annually historically, but because you're stock picking, you want to have a higher return. So therefore, we start at 11 or 12%. But of course, this can be higher if you have a penny stock that has a really high risk factor. You of course want to have more returns. But given, of course, that Netflix is quite the behemoth and the name out there, let's put it at 11%. Margin of safety is something that's personal to you, and also depends on how much you know the industry and the company as well. I mean, Netflix is not really a difficult company, so I would be willing to put is around 10%. But for example, if you have a company like Thales, for example, super high tech industry, you have to know every nook and cranny, so the margin of safety there goes up. And also depends on your age. If you're younger, you can lose some money and recoup it during your time at work. But when you're older, you don't want to spend all your life savings, so then your margin of safety also generally goes up. So 10%.
Yep.
And what do we do, Kirill?
We hit the analyze button, and then I need to do a little bit of explanations because now it looks too green. Of course, especially comparing to the price of $96 at the moment. But I can tell you guys that this one so the results for the target valuation formula and the NPV formula are so high because some of the numbers are still based on the pre-stock split stock price. So before that, Netflix was around $1,000 per share. Now it's at around 100. So you have to divide these numbers. So 1,800 and 600 by 10. So then our target valuation formula would be around $180 per share, and our NPV would be around 60. So if we, after this very important disclaimer, if we look at the rest of the stuff, I'm actually pretty surprised, but to see that it's actually quite high, even considering our existing assumptions, because discount cash flow formula of gives us 120, even Ben Graham's says 150, which is also pretty rare. So I think on the bottom line, even with our margin of safety, I think we can say that the current price would be pretty interesting to look into and to start the position in Netflix. If Robin also allows me a moment, I'll just quickly check what are the technical ranges real quick. So we are almost at the support line. So I think if it goes down to 83, 85, $86 per share, that would be pretty much the most local support position on the graph where most likely the stock will bounce from, because you can see also the trend, the rising trend has been there for quite a while, for a few years already. So yeah, I think the most important part now that would play the most important role in the stock is, of course, the deal, if it's going to go through or not, on what terms, and of course how exactly are they going to be managing their top line and bottom line growth. I think that's why also the stock has been in a bit of a wobbly position for the past half a year or so. So I would say keep it in mind, maybe put it on your watch list already, just to keep an eye on it. And of course, as Robin always says, do your due diligence, check your assumption. Also with 930, you can have a look, you can do all of this yourself, and then you can just see and you can find the price that you're actually willing to pay for the stock.
Yeah, exactly. Agree. Then there's always one more thing. Where can the users get the app?
Yes, so you guys can go to 930.com. Robin always leaves in the description. There's even a discount code. You can have a look into it, but you don't even need it. If you want, you can just go on the platform. You can look at the demo. For the demo, you don't even need to create an account. Just have a look, browse around. If you want to play around, you can sign up completely for free. No cash, no credit card required, no nothing. You can just do a couple of companies on your own, just to see if it fits for you. And if you would be interested to support us and to have more features, for example, adding your companies in a watch list with your assumptions, having a screener, make a use of the 930 score, and many more upcoming updates. You can also check some other pricing plans if you would be interested, and especially locking up the price for now, because we're going to be shipping a new update rather soon. Probably in the beginning of next year, I hope. Maybe even before that. We'll see how it goes. But yeah, if you're interested, stay tuned with us. We are having many fun stuff coming your way. So yeah, make sure to check it out and let us know what other companies you want us to look into. I would be really happy to hear that.
Yes, and with that said, thank you for watching. Thank you, crew, for your lovely insights, and we'll see you guys in the next video.